Ever been faced with a choice that feels like it could go either way? Maybe a new job offer or a chance to invest in something.
Yeah, or even just taking on a challenging side project.
Exactly.
Hmm.
How do you really dig down and figure out if it's the right move? That's kind of the core question we're tackling today on the deep dive.
Hmm.
Our source material looks at how contractors, in construction decide whether to bid on a job. But honestly,
Yeah,
the principles we're going to unpack are, well, surprisingly universal for anyone weighing a new opportunity.
that's so true. Think of this less as just industry-specific talk and more like a peek into the strategic playbooks of experienced pros.
Right.
They don't just jump at every single chance.
Hmm.
They carefully evaluate a whole range of factors before committing.
And understanding how they do that, well, that can give you a real edge in your own decision-making, right?
Definitely.
Yeah.
We're aiming to distill that strategic thinking into insights you can actually use, no matter what your field is.
Okay, so get ready to go deep. We're going to explore this multi-layered process a contractor goes through when considering a project.
Where do we start?
Well, how they even find out about potential work, the critical self-assessment involved, things like their team's expertise, the quality of the project plans.
Oh, like that groundwork.
Yeah, all the way through to the nitty-gritty of finances and even like the personalities of the clients and architects.
The human factor, always important.
Totally. Plus, we're going to try and demystify something called surety bonds.
Oh yeah, bonds. Crucial.
And explain why they're often a really key and sometimes overlooked part of landing those bigger construction projects.
Okay, let's dive in. That fundamental first step.
Mm.
How do contractors even learn about potential jobs? They don't just, appear, right?
No, definitely not. They need to actively seek them out. Our sources point to a few main ways they stay plugged in.
Like what?
Well, for public projects, the ones funded by taxpayer money, you'll often find listings in the traditional places. Newspapers, trade journals.
Government publications too, I bet.
Exactly. Basically, a public call for bids. Private projects might pop up there too, but it's the electronic news services where
Yeah.
things get really interesting.
The subscription stuff.
Yeah, apparently there are services names like McGraw-Hill Construction Dodge Reports, Reed Construction, and online platforms. ConstructionWire.com, BidClerk.com.
So, specialized news feeds for construction.
Pretty much.
Yeah.
They give really timely info on project developments. It helps contractors spot opportunities that fit their skills and location.
That's like having an intelligence network, right?
That's-
Getting that early heads up.
Totally. But beyond those formal channels, the source also mentions something maybe a bit underestimated.
What's that?
The value of local builders, exchanges, kind of like industry networking hubs and just, good old-fashioned community connections.
Word of mouth. Still powerful. Building that local reputation, knowing people, that can be a huge advantage, especially for private jobs where trust is key.
Okay, so a contractor spots a potential project. Now comes the big question, the one that could save them tons of time and, well, money.
Which is,
Does this project actually make sense for them to pursue? Because, like our source makes really clear, putting together a bid, that's a serious investment.
oh, absolutely. It's not just throwing a number out there. Crafting a thorough, competitive bid takes real effort. Time, money, expertise.
I can't just chase everything that
No
moves.
way. And there's that saying in the industry, right? Be careful what you bid on.
But you might get it. Yeah, I saw that. Once a bid's accepted, it's legally binding.
Exactly. So they have to be super strategic about where they focus their bidding energy. What's one of the first things they look at?
Well, right at the top, their own experience. Specialization seems really key here.
Mm-hmm.
Bidding on work that's, like, outside your normal lane, that sounds incredibly risky.
It is. Think about trying to estimate costs accurately or even just being sure you can do the work properly if it's something new.
How do you even predict the labor costs for something you haven't done before?
That's the million-dollar question, isn't it? The source uses a great example with concrete foundations.
Yeah.
You might be able to figure out the material cost, the concrete itself, pretty easily from the plans.
Okay, that seems straightforward.
But the labor,
Yeah.
if you haven't done that specific type of foundation work, estimating the time for forming, handling, finishing, even waste, it's almost a guess without solid historical data.
Right. You need that hands-on experience.
Absolutely critical. And if you get that bid wrong,
Uh-oh. What happens?
well, if you underbid just to win it, you could end up losing money. Or worse, maybe cutting corners on quality, which is never good.
And if you overbid?
Then your chances of actually getting the job basically vanish. And even if you do get it with a bad bid, being inexperienced on that specific task leads to inefficiency, drives up your real costs.
And eats away any profit you thought you had. Ouch.
Exactly. So experience is huge. What's next on the checklist?
Okay, moving beyond their own skills. The quality of the design information, the plans, the specifications.
Yes. You can't build reliably from bad blueprints. Imagine trying to price something complex if the drawings are incomplete or contradictory.
It sounds like a nightmare. It's just asking for problems later on, isn't it?
Totally. Our source gives this really practical example. A roofing contractor looking at an old house.
Okay.
Until they actually tear off the old roof, how do they know the condition of the wood underneath? The sheathing, the joists,
Yeah.
maybe it's all rotten.
Right. You can't see through the existing roof, so how do they bid that? It feels impossible to price accurately.
Well, that's the dilemma. They have a few options, none of them great.
Like what?
They could just say nope and pass on the bid entirely, avoid the risk.
Okay, safe bet.
Or they could try to price it with a lot of uncertainty built in. Basically guessing and hoping for the best, which is a huge gamble. Or they could try to write specific clauses into the contract, saying, if we find hidden damage, it'll cost extra. But the owner might not agree to that.
Tricky.
Ultimately, poor design info just creates risk for the contractor. It often leads back to underbidding, absorbing unexpected costs, maybe cutting corners,
Damaging their reputation.
or even facing real financial hardship. It's a big deal.
It really is. And it's not just the technical stuff either, is it? The source also stresses the importance of the people involved.
Ah, yes, the other team members, the owner, the architect. Construction is risky financially, so having a good collaborative team is essential.
You need everyone pulling in the same direction.
Absolutely. The contractor's going to want to suss out the owner, right? Are they reasonable, easy to work with, or do they have a bad reputation?
Like being difficult, or maybe even litigious.
Exactly. The source actually quotes, litigious owners could spell trouble. It may be best to avoid an owner who has a reputation for filing lawsuits.
Wow, that's pretty blunt. It speaks volumes.
It does. And they'll also look at the owner's sophistication. Do they actually understand the building process and its complexities?
Okay, so evaluating the owner is key. What about the architect?
Similar deal. How's the quality of their work? Are the drawings clear, complete, well-coordinated? Are they responsive? Easy to work with.
Because the architect often manages the contract, right? Acts as the owner's agent.
That's often the case. So a difficult architect can make the whole process incredibly painful. The source even compares it to marrying the team for the project duration.
That really drives home how important those relationships are. A bad marriage can doom the project.
Or at least make it extremely unpleasant and costly.
Okay, let's shift gears slightly. What about the type of contract? Does that play a role in the decision?
Oh, definitely. Different contract types distribute the risk differently. A lump sum contract, for example.
That's where you give one fixed price for the whole job.
Right. That puts most of the risk on the contractor. If costs run over, it comes out of their pocket.
Versus, what's the alternative?
Well, something like a cost-plus contract. There, the contractor gets paid for their actual costs, plus an agreed-upon fee or percentage. Less risk for the contractor generally.
So they have to weigh that risk against the potential profit for each contract type.
It's a constant balancing act, finding that sweet spot.
Makes sense. And location. We always hear location, location, location.
Yeah.
For real estate, does it matter as much in construction bidding?
It absolutely does. Local projects usually have big advantages.
Like what?
Easier management, lower overhead costs.
Yeah.
You're not trucking people and equipment long distances. Plus, you likely have a much better feel for the local subcontractor market, the suppliers.
So you can probably estimate costs and labor more accurately?
Generally, yes. And building those strong local team relationships is often easier, too. It all contributes to smoother execution.
Okay, local is often better. What about the timeline, the schedule?
Crucial. First, does the contractor even have the crews available? You don't want to overstretch your business.
Right, taking on too much work at once.
And second, is the owner's proposed timeline actually realistic? Can a quality job be done in that time?
If the schedule seems impossible, that's a red flag.
A big one.
Yeah.
And tied into that are liquidated damages clauses.
Ah, I saw that mentioned. Explain those again.
Sure. They're basically penalties the contractor has to pay the owner for every day the project is late.
Oh, wow. Like real money.
Yeah, the source gives an example of $1,000 a day. If you're 20 days late, that's $20,000 straight out of your potential profit.
Yikes. That could wipe out your entire margin on a tight job.
Easily.
Hmm.
So aggressive schedules combined with liquidated damages, that represents a significant financial risk.
Now, the source did briefly mention the flip side too, right? Incentive payments for finishing early.
It did. It mentioned the Santa Monica Freeway project as an example. C.C. Myers finishing way ahead of schedule and getting a huge bonus. That can happen, but the downside risk of damages often weighs heavier in the initial bid decision.
Gotcha. Okay, zooming out a bit, what about the general state of the economy? Does that influence the decision?
For sure. The local economy and the overall profit potential are always factors. If the market is really hot, everyone's busy.
Good for business, right?
Yes, but it can actually make it hard to find good, reliable subcontractors. They might be booked solid or charging premium rates.
Ah, okay. And if the economy is slow?
Then you've got the opposite problem. Stiff competition for the few jobs available. Bids tend to go lower, squeezing profit margins way down.
So you have to adjust your profit expectations based on the market reality?
Exactly. It's another balancing act. And finally, the source mentions one more factor, kind of the intangible one,
What's that?
just the contractor's desire for the job. Sometimes there are non-financial reasons to really want a specific project.
What kind of reasons?
Maybe it's a chance to break into a new market sector. Or it's a really high-profile project that would be amazing advertising.
Good for the company image.
Yeah. Or maybe things are just slow and they want to keep their core crews busy, even if the profit isn't stellar on that one job. It's about the bigger picture sometimes.
So it's this whole mix of factors: workload, labor, experience, design info, timeline, contract, team, location, economy, profit, desire. They weigh all of that up.
They do. And then they decide. Do we invest the time and money to put together a serious bid, or do we pass on this one?
It's a really complex decision process. Okay, let's switch gears now, because even if a contractor wants a job and thinks it makes sense, there's another big hurdle: bonding.
Oh, yes, bonding. This can be an immediate disqualifier for some contractors, right?
That's what our source suggests. It's a critical piece of qualifying for many, especially larger construction jobs.
At first, just to be clear, we're not talking about municipal bonds like buying city debt or something.
No, definitely not. This is different. In construction, we're talking about surety bonds, and their purpose is all about reducing risk,
Risk for whom?
primarily for the project owner. Think of a surety bond as a three-party agreement.
Okay, who are the parties?
You've got the surety, that's usually a specialized insurance company. Then the contractor, they're called the principal. And finally, the beneficiary, usually the project owner.
Or sometimes a general contractor if it's a subcontractor bond.
Right. And these bonds basically act as a guarantee covering specific risks.
What kind of risks are we talking about?
Well, for the owner, several big ones. The risk that the lowest bidder just walks away and doesn't sign the contract.
Forcing the owner to take a higher bid.
Exactly. Or the risk that the contractor starts the job but then fails to complete it, maybe goes bankrupt.
Leaving the owner with a half-finished building. Nightmare scenario.
Totally. And also the risk that the contractor doesn't pay their subcontractors or suppliers.
Which could lead to liens on the owner's property, right?
Yeah.
Even if the owner paid the main contractor.
Precisely. That's a huge headache owners want to avoid, so the bond protects against that too. And GCs want similar protection from their subs failing.
So the source summed it up as, surety bonds are a tool for reducing risk on a project. Makes sense.
And the size of the bond needed is usually tied to the project value, which means
If a contractor can't get a bond big enough, it limits the size of projects they can even bid on. It's a built-in qualifier.
so how do they actually work? What does the surety company do?
Essentially, the surety company guarantees the contractor's obligations to the owner. If the contractor defaults, gets into financial trouble, abandons the job, whatever the surety steps in.
Steps in how? To finish the job.
They have options, but yeah, their fundamental promise is to make sure the owner doesn't suffer the loss from the contractor's default up to the bond amount. They ensure the project gets completed.
Okay, now you mentioned surety companies are often insurance companies, but this isn't really like typical insurance, is it?
That's a really crucial distinction. Insurance companies expect to pay out claims as part of their business model. It's based on pooling risk.
Right, like car insurance or health insurance?
Surety bonding is different. It's more like an extension of credit. The surety underwrites the contractor, believing they will perform. They don't expect losses.
So if the surety does have to pay a claim because the contractor failed,
They will absolutely turn around and seek full reimbursement from the contractor. They have indemnity agreements. The source mentions an example, Superior Construction Company, having to repay the surety after defaulting.
So the contractor is still ultimately on the hook financially. The bond is there to protect the owner.
Correct. And these surety companies, they're regulated, right, by
Like
state departments of insurance?
Yes, to make sure they're financially sound and can actually pay claims if needed.
And it's usually the owner who decides if bonds are required.
Yep. It's very common for large private projects and pretty much standard practice for public works jobs. If it's required, the contractor has to get the bonds.
And the cost of that bond, the premium, just gets built into the contractor's bid price.
Usually, yes. And the bond value and premium might adjust if the contract price changes significantly during the project.
Okay. So what are the main types of surety bonds we see in construction?
Our source focuses on three main ones, all bought by the contractor, all benefiting the owner. They are bid bonds, performance bonds, and payment bonds.
Let's take them one by one. Bid bonds. What's the specific purpose there?
The bid bond assures the owner that the contractor who wins the bid will actually sign the contract at the price they bid.
So it prevents bidders from just backing out after they win.
Exactly. If the low bidder defaults, the surety might have to pay the owner the difference between that low bid and the next lowest responsible bid, up to the bond amount.
Okay, gives the owner some security during the bidding phase. How much are these typically?
Usually around 5 to 10% of the bid value. And they're submitted with the bid package.
Got it. Okay, next up, performance bonds. Sounds like what it is.
Pretty much. It guarantees the owner that the contractor will complete the work according to the plans and specs at the agreed price, plus any approved changes.
And this comes into play if the contractor defaults during the project.
Right. Like, if they go bankrupt and abandon the job, that's a major default. The owner files a claim with the surety.
And what does the surety do then? Just write a check.
They have options. They might provide financing to help the original contractor finish, if that seems feasible.
Yay.
Or they might hire a replacement contractor to take over and complete the work.
Who picks the replacement?
It usually has to be someone agreeable to both the owner and the surety, or the surety could just pay the owner the cost to complete the project themselves up to the bond limit.
And washes their hands of it?
Sort of, yeah. Or in some cases, if they dispute the default, they might fight it in court.
Complex. And how much are performance bonds typically for?
Usually 100% of the contract value. They're purchased after the contract is awarded, but before work starts. The cost depends on the contract size and the contractor's bonding rating.
Okay, so bid bond for the bidding phase, performance bond for getting the work done. What's the third one? Payment bonds.
Right. Payment bonds, sometimes called labor and material bonds. These assure the owner that the general contractor will pay their subcontractors and suppliers.
Ah, this protects the owner from those mechanics liens we talked about earlier.
Exactly. If the subs and suppliers get paid by the GC, or by the surety via the payment bond if the GC fails to pay, they have no grounds to file a lien against the owner's property.
Another layer of protection for the owner. Are these also for 100%?
Typically, yes, 100% of the contract price. And they're usually provided along with the performance bond when the contract is signed.
Okay, bid, performance, payment. Got it. This source also mentioned one other type briefly, contractor license bonds.
Yeah, those are a bit different. They aren't usually project-specific. Some states require them just to get or renew your contractor's license.
What do they guarantee?
Basically that the contractor will follow state laws and regulations. They offer some limited protection, usually to consumers harmed by defective work or license violations, or sometimes to unpaid workers or suppliers.
So more about general compliance than a specific project.
Generally, yes. The requirements and amounts vary a lot by state. California was mentioned as an example, requiring a bond for the state license.
Okay, so it's clear these bonds are important safety nets. But the big question is, how does a contractor actually qualify to buy them? You said it's tough.
Right. It's the contractor who has to qualify, not the owner buying the bond. Because the bond is guaranteeing the contractor's performance and financial responsibility.
And surety companies are picky because they're taking on risk.
Very picky. Qualifying can be a long, involved process. Each surety has its own detailed guidelines, but they all tend to focus on what our source calls the 3 C's.
The 3 C's. Okay, what are they?
Capacity, capital, and character.
Capacity, capital, character. Let's break those down. Capacity, what does that mean?
Capacity is about the contractor's ability and skill to actually do the specific project they want bonded.
So, like, their experience.
Exactly. Experience with that type of work, their track record, their current workload. Can they handle this job on top of others? The project size,
Their
location.
team, their equipment.
Yeah, their
Okay.
whole organizational setup and management structure. Do they have the physical and managerial resources to pull it off?
Makes sense. Okay, C number 2, capital. Sounds like money.
It is. Capital refers to the contractor's financial strength. Do they have enough cash or assets they can easily convert to cash to fund the work between owner payments?
There's always a lag in payments, right?
Yeah,
You have to cover payroll and materials up front.
definitely. And can they handle unexpected costs or delays without going under? The surety needs to see that financial stability to justify the risk.
Right. Capacity, capital. And the third C was character. That sounds a bit more subjective.
It is, but sureties consider it incredibly important. Character is about the integrity, honesty, and reputation of the contractor's owners and key managers.
So basically, are they trustworthy? Do they have a history of fulfilling their obligations?
Precisely. The surety wants to feel confident that the contractor will try their best to meet the contract terms ethically. They'll look at past behavior, maybe check with the Better Business Bureau, licensing boards.
Get references from past clients, suppliers.
Yeah, all of that. They dig pretty deep to assess that character element.
So to evaluate these 3 C's, contractors have to provide a ton of info, I assume.
Oh, yeah. Lengthy qualification forms, details on past and current jobs, project values, types of work, bank statements, full financial statements, lots of references.
Yeah.
It's a thorough vetting.
Okay, so if a contractor gets through all that and qualifies, what do they get? Like a thumbs up?
They typically get what's called a surety program or a rating. This sets their bonding limits.
Limits? Like how?
It usually specifies 2 things: the maximum bond amount they can get for any single job and a maximum aggregate amount.
Aggregate meaning the total value of all their bonded work at one time.
Exactly. So say a contractor has a $5 million single job limit and a $10 million aggregate limit.
Okay?
If they already have $8 million worth of bonded work in progress and they want to bid on a new $4 million job.
That new job is below the $5 million single limit, but
Uh-huh.
$8 million plus $4 million is $12 million. That's over the $10 million aggregate limit.
Right. So the surety would likely deny the bond for the new $4 million job, even though it meets the single job criteria, because it pushes them over their total aggregate limit.
Ah, okay. But wait, is that aggregate based on the original contract value or the amount left to finish?
Good question. The source clarifies it's typically based on the estimated cost to complete the open projects.
Okay, that makes more sense. So in your example, if that $8 million job only had, say, $5 million left to complete.
Then $5 million remaining plus the new $4 million bid equals $9 million total cost to complete exposure.
Which is under the $10 million aggregate limit. So they might get the bond then.
Exactly. It's about the remaining exposure. And sureties keep tabs on this, monitoring project progress, sometimes needing to approve change orders that increase the bonded amount.
Wow, it's a whole ongoing relationship with a surety company.
Definitely.
Yeah.
So bringing this all back together, the decision to bid is just incredibly layered, isn't it?
It really is. You've got the internal assessment workload, labor, experience, then the project specifics, design info, timeline, contract type, location, the team members, the market conditions, profit potential, strategic desire.
And then overlaying all of that, the whole bonding requirement, which acts as this immediate, often tough filter.
Right. Bonding can knock you out before you even get deep into the other factors. But even if you can get bonded, any one of those other elements could still lead a smart contractor to say, you know what, this one's not for us.
This whole deep dive into how contractors make these calls, it really highlights that deciding to pursue any big opportunity, whether it's construction or something totally different in your own life, it's rarely simple.
No, it's this complex blend of looking inward, what are my real capabilities? And looking outward, what are the risks? What's the environment? Who are the players involved?
And thinking about both the short-term payoff and the long-term strategy.
Absolutely. And it's fascinating to think about the parallels, isn't it? What's the equivalent of, say, incomplete design information in your world? Or a difficult owner you might have to deal with?
Yeah, or what's your personal bonding capacity? Is it your financial resources, your reputation, your specific skills or credentials?
Exactly. What allows you to even be considered for certain opportunities?
That's a really powerful way to frame it. So as you're listening, maybe think about those bids you're considering in your own life or work. What are your versions of the plans, the team, the surety bonds?
What criteria are you using, maybe implicitly, to decide if an opportunity is truly the right fit, beyond just that initial excitement or appeal.
Definitely something worth reflecting on. Food for thought.